Hey, good morning, everybody. Welcome to Thursday. It is February 10th, and yesterday, not a bad day at all on Wall Street. We'll talk about that and more, I'm sure. We'll talk about unemployment today because that comes out, as well as we've got a slew of earnings from some top companies that you will definitely recognize, the likes of Coca-Cola, Uber, the likes of Twitter, and Mattel. So a lot of things to talk about today. Looking forward to our conversation with Dave. But before we move over there, let's just talk a minute about and remind you about the one thing that any of us can control when it comes to our portfolio. The only thing that you or I can control is how much risk you have. We can't control the government, the geopolitical concerns. We can't control the volatility in the market, but we can control how much risk we take when it comes to the market. That's why we developed the core retirement design to help you design the retirement you always dreamed of. Give us a call at 863-382-0037 to schedule your core retirement design. And with that, we've got Dave coming up next.
Light FM, your rhythmic show there. Morning Dave is here. It's 8:40 now, 20 before 9. And if you've been visiting another planet, we got an inflation issue. We kind of got it quantified today out of the federal government. Let's go downtown and talk to Phillip Stadler from Statler Financial Services and see what his reaction is to it. Phillip, good morning. How's the gas prices this morning?
Man, gas prices, well, they're holding steady, at least in my neighborhood. So, I'm not sure your neighborhood, but dude, it was
in your neighborhood.
Yeah, but hey, it was cold this morning. My thermometer on the truck said 38 degrees. I'm like, oh my goodness.
It was on the nippy side this morning. That's for doggone sure. I was making fun of the gas prices because that's the thing all of us complain about. But federal government released how our inflation rate is, and hey, guess what? We can now say it's another new record. It's too bad it's not a record we wanted, right?
That's right. Unfortunately, I saw numbers saying, hey, and it keeps referring back to this, right? We saw this last month too. 1982. You got to go back to 1982 to see this kind of inflation numbers being printed. And so, man, to see the CPI go to 7.5%, that's a big number, Dave.
Absolutely. And it doesn't look any better when you get rid of the little electives like gas and food and the like, because the core CPI also beat what expectations was, another 0.6% up last month. And the core, excluding food and energy, was up 6%, which is also another 40-year record. The thing that scares me is when you mention 1982, this is something I've been talking about for some time when we've been talking about inflation. 1982's inflation rate numbers were the thing that prompted the Fed to go apey on inflation, and it flushed us down into a really, really deep, although we will say short recession. Not necessarily looking at the Federal Reserve to do that again, but I got a sneaking hunch, your prediction that they might be thinking about a 0.5 point bump in the interest rate next month, starting to sound like a fait accompli, isn't it?
Well, I think so. Hey, the other thing I do, I think because of the inflation numbers, and then to give some more credence to that, Dave, I did see a report out of Bloomberg that gave a survey of economists across the country, and not one of them have any expectations for inflation to be below 7% for the rest of this year. So that's concerning that some of them think it can actually be a lot more than 7% before we get through this year. That's even more concerning.
That really is a scary thought. And, when we were spending money like crazy during the pandemic, we all said, okay, we need to prime the pump. We need to keep people afloat while things were going down. But combining that with the other programs down the line, there were also those little voices out there saying, folks, beware of hyperinflation coming in. At the very least, gosh, I hate saying we were right.
But yeah, you and I have been talking this away for a long, long time, way before the news media started talking about it, the guys on Wall Street talking about it, but we could see it coming, and the Fed just sat on their hands and didn't do anything until now. And obviously now they're going to pour all kinds of ammunition on the fire.
And the ammunition has a good chance of blowing up in our face, which always worries because I've always said the Federal Reserve in the United States is a bunch of very smart guys, but around the world they are not reputed as having the best reactive skills to economic stimulus. And where they're being stimulated right now to do something, and their history is to either overreact or underreact. So the March Fed meeting is going to be a really interesting experience to watch.
Yes, sir, it sure will be. And we will be sitting on pins and needles until that happens.
Absolutely. The smart money is moving. We were talking before we went on the air that I had green ink until those 8:30 numbers came out and things turned red. And the other thing that happened was folks started buying federal bonds like they're going out of style. We're bumping our schnozzes on the 2% rate in terms of yield on federal 10-year bonds. When you compare the fact that we were looking at sub 1% numbers for a little while in there, that's quite a change.
It is. Now you have to go back a little ways to get those sub 1 numbers, but still in the last 2 years, we've been down that low. And we start out this year, I think it was somewhere around 1.3, 1.35% on the 10-year treasury. Now we're up to almost 2%. It doesn't seem like a big number, but when we're talking about the 10-year treasury, a 0.1% increase is a big increase when it comes to that interest rate.
Absolutely. Yeah, the sub 1 numbers did come during the depth of the pandemic recession, but even allowing for that, that's like doubling the interest rate on companies that figured, oh, this is going to stick forever, so what the heck, let's borrow some money. Hey, guess what? Your cost of borrowing just darn near doubled over the last 2 years.
That's right. It did. It's gone up substantially. And everything today is focused on that because jobless claims came out today too. And, hey, it's not much to talk about. And it sure did not help the markets at all. It was a little better than expected. But man, you were so right. As soon as that number hit, my future started dropping like rocks. We went from nice green ink to pretty substantial red ink.
Absolutely. And even some surprising reports during earnings season aren't helping it. The one that caught my eye the most when we were talking before we went on the air was Twitter missed their numbers, but they're still going up. How did they do last quarter anyway? And why are they going up as much as they are?
Here's the deal when it comes to Twitter. Twitter missed on bottom line, top line, and what do they call it? The monetization per look per day, monetizable daily activities, what they call it, and that missed as well. So they missed on all three of the key points that everybody looks at. So I don't, I can only make some conjectures as why it's going up. It's not up as much. I mean, it was up 6.6% earlier this morning. It's only up about 3% right now. The only thing that I can lead any credence to right now is that they put out that they're going to have a $4 billion stock buyback program, and $2 billion of that is going to happen here real quick. So they're going to buy back $2 billion worth of their stock here. I don't know what quick actually means, but I'm thinking in the next 6 to 12 months is quick for a company to buy that much of their stock. The other $2 billion will happen over some more elaborate time periods. But Dave, that's the only thing I see that could be driving that price up.
Kind of interesting. The other alternative is that everybody said sell, and they got Twitter and Facebook confused because Facebook is still tanking. They're down by like 1.5% this morning in pre-trading. They're still getting beat up for having an off report last week.
Oh, well, they are, and I think Twitter just added to that, right? If Twitter missed, that just means Facebook's having that much more issue probably too. So it's that type of effect, even though Twitter's not going down right now. I think the only thing that's propping them up, like I said, is that stock buyback program.
It does sound like it. There are some other household names that are reported this morning. We didn't mention it beforehand. Is something going on with Disney? Because they're kind of leading my big leader list. They didn't report, did they?
They did not report. I did see a little blurb. It's not on my tip sheet. I'll find it though before we get off the air.
Okay, because they're up like 7% this morning on the pre-market trading, and against what we're looking at in terms of the markets as a whole, there has to be some interesting news there. Who do we have reporting this morning?
So we've got a couple things here. We got Coca-Cola, big name brand, Coca-Cola. They beat the street by 4 cents a share. Came in at 45 cents. Revenue beat the Wall Street forecast as well. They've looked at some commodity price inflation. And they think it's not going to be quite as bad as they anticipated for 2022. And so they're trading up almost 1% this morning.
Cool.
Pretty close to their 52-week high too. So we had Coke. We talked about Twitter. We had Tapestry, which is the holding company for Coach and Kate Spade brands, those luxury lines, and they did well this quarter as well. They beat substantially on the top line. Revenue beat on bottom line. So they raised their full year guidance, which, that's good across the board. Demand for luxury goods seems to be not hampered by what's going on in the marketplace and the economy. Tapestry is up 1% this morning.
All right. I've always find luxury goods a really good bellwether number, just on the grounds that if you can buy something premium price, it means the economy is at the very least holding up all right.
Oh, I do have Walt Disney. I must have scrolled right past it, Dave. Sorry about that. They had a good quarter. They came in at $1.06, which they were only expected to make 63 cents a share. So that's a substantial beat. They had a lot of help from their growth in their Disney Plus subscriber base, which, that's their streaming service. And so that's recurring revenue that's coming in every month for them. They saw record profits from their theme parks. Not sure. I guess probably cutting costs and people finally getting out and being able to come to the parks. So that's why they're up about 6.5% right now.
Absolutely. Yeah, I was thinking that also indicates interesting futures for Netflix, because there seems to be becoming a zero-sum game between these streaming service. Netflix got whacked because their subscriber growth really leveled off. Disney now says they're up. It's almost starting to look like the toy industry, where there's a little bit of zero-sum game involved here, isn't there?
That seems to be the case. And you talk about toys. Hey, we talked about Hasbro earlier this week. Let's talk about Mattel today, because they came in. They beat by 23 cents a share. They came in at 23 cents a share, which is a lot better than they were expected to come in. Their revenue beat forecast as well. Their Barbies are doing well. They gave upbeat guidance for 2022, which, that's good news for them. They're up 8% this morning.
All right.
Actually, they'll open at a new 52-week high right now if they keep it up.
Cool. Tying Disney and toys together, thematic tie here. It works like a charm. Yesterday we were up. We had some really, really good numbers yesterday, as a matter of fact. The Dow was up by 305 points. Standard & Poor's was up by 65.5. NASDAQ was up by a full 2% plus, up $296 yesterday. I got to sound enthusiastic about that, because, boy, things aren't going that way this morning after that inflation report, Phillip. 45 minutes early. Where are we anyway?
Dave, let's just say that the NASDAQ is going to try to give back all that not quite, but right now they're giving back a lot of that gain yesterday. NASDAQ 100, we'll start there, is down 1.5%. The S&P 500 is down, not quite, but almost 1%. The Dow 30 is down almost 0.5%. Some big numbers there. The other things that are moving today is silver. That's flat. Gold's down 1/3%. And then before I give you crude oil, I ran a number that we haven't talked about in a while, and that is cryptocurrency. So since February 1st open, both Bitcoin and Ethereum are up 17%.
Wow.
Yeah. I thought that was pretty good.
Beat up. They really got beat up for a little while too. They're coming back. Yeah.
They really did. Now I'll give you crude oil, because it's not going the right direction either, Dave. It's up 0.5% to $90.11 a barrel.
Well, poop. Overseas markets, you can almost tell the tale of the tape. Japan closed early while we had good news. The Asian rim markets are almost all up. Europe is taking a look at us and going, huh? They were green 25 minutes ago. They've turned red as well in response to our inflation numbers. One of those times it's kind of poster child for getting planned and knowing where your risk factor is, Phillip. If you've got some flyers in that retirement portfolio, you're probably not having a good morning. How do I find you to find out where the risk is?
Dave, that's one of the things. That's why we developed our core retirement design, to help people identify and build a portfolio that's going to line up with the amount of risk they can truly handle during the ups and downs of the market. Give us a call at 863-382-0037 to schedule your core retirement design. And then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk 730 and 95.3 FM.
I got a sneaky hunch you're going to be talking about Super Bowl investing or something like that on this weekend.
You know, we'll talk a little bit about the Super Bowl for sure, seeing how that's what's happening this weekend.
All righty. And we'll be back again with you tomorrow morning here on Light FM. Thank you, sir. We'll catch you then, all right?
All right, man. You have a great day.
Take care. It's 105.7 Light FM and Statler Financial Services, Phillip Stadler.
Hey, guys, I want to thank you for joining us today. It is Thursday. I hope your week's going well. I hope you'll join us again tomorrow as we close out this second week of February. Until then, have a great one. Bye now.